Hello everyone and welcome into today's video. Today's video we're going to be talking about Adobe stock, which its price has been getting hammered for quite a while, even in the past month. We can see the stock is down another 20%, under 200. And this is already on the back of the stock doing very poorly as of the past year, and even on pretty much any time basis you look at. So year to date it's down 41%. If we go over a full year, I believe it's down something like 50% ish. Yeah, just about 50. And then if you back it up to a 5 year, the stock is down a tremendous 64%. So I wanted to talk about this stock because one, I do have a position in it, and the valuation on the stock is getting extremely cheap. So I kind of want to talk about it and just go over some of my thoughts on the different threats that the business is seeing, the reason the stock price is so depressed, and if I think this is going to end up being a value trap or not. Because as we can see right now, on pretty much any metric you're going to look at on the company is going to look very attractive from a valuation standpoint. Because you look at the trailing 12-month PE, it's not even at 11 right now. The forward PE of an 8, if you're looking at it on a price to free cash flow of 7.5. And if we go ahead and go into the insights, this company has really good margins. It has very good metrics you look at and you'd go, okay, this is a high quality company, such as gross margins of near 90%, free cash flow margin of 40%. If we're looking their ROIC, which is a metric I always love looking at, of 54%. Some other good metrics down here. Revenue growth of 11.4. We can see free cash flow is a little slower, which we don't like to see. But as you can see, there's a lot of good metrics here. So it brings into question, how come the stock price is so depressed, which a lot of it has to do with the SaaS apocalypse that's been going around, but there are some actual true concerns with that. And it's not all just what I'd consider FUD, fear, uncertainty, doubt. I think there's some actual good reasons for why. So for those who don't know what a value trap is, for newer investors, this is when you have a company that looks very cheap on a valuation basis, like as we're seeing here, under 8. But the reason for this is because the market is already pricing in the lower expected growth or even loss of market share that the company's going to be experiencing going forward, which is why it's going in to that lower valuation. So while it looks like it's undervalued from its intrinsic value, the way the stock price starts to match the intrinsic value is the intrinsic value actually starts to fall over time. If you're thinking of it from a conceptual basis, every company is just valued on the cash flows that company is going to produce into perpetuity. So basically to when the company stops existing, and you discount it back to today. So if you have something to where people are starting to think the cash flows may start going down over time, even if it's 5-10 years out, then the long-term value of the company can decrease a significant amount, especially the farther out you project, which is what the market's looking at a lot. So first, I want to go ahead and pull up their press release from their latest earnings. So on their press release, which I have right here, one good sign is their AI revenue is seeing really strong growth. It triples year over year, exceeding 500 million. One thing here, though, is that that's not a very large percent of their revenue. And the other thing is, so first, that's going to take a while to start becoming meaningful to the top line. Next, the markets have been uncertain on how profitable this revenue is going to be, especially compared to their traditional subscription-based revenue and the margins on that. As we saw, gross profit margins at 90%. Are they going to be able to maintain those margins? We really don't know. These are unanswered questions. So that's something the market's going to be curious on. And then on top of that, we don't know if this growth is going to continue as the numbers get bigger. Obviously, law of large numbers. So as that number starts expanding higher and higher and goes from 500 million to a billion to 3 billion, etc., that growth rate is going to slow down. But how much does the growth rate start slowing down? Does it keep these triple digit percentage gains as that number gets higher? Probably not, but will it still remain in the double digits? Is it going to come down to the single digits? It's very easy for a company of this scale to grow at these extremely high growth rates on a small revenue base. But once you start getting up to the higher numbers, is that going to continue? And I think that's the main thing when I'm looking at building out my thesis for this company is, do I think this AI is actually going to be a tailwind or a headwind for the company? Because the way I see it and the way I think most investors should look at this before they decide if they're going to invest in this company or not is you got to play out 3 scenarios. The first one is going to be the most bullish scenario in which AI is a tailwind. So right now they're charging a lot for the generative AI credits on their products, which they have a lot of creative products that professionals and enterprises use in developing like certain marketing material, stuff of that nature. But if they're able to upcharge on those generative AI credits in their software, and it actually accelerates revenue faster than it's accelerating than for the loss of subscription revenue they're losing to seats, then this is going to be ultimately a tailwind that re-accelerates revenue growth. So for that, let's say the AI products make creation of this material so much more efficient than instead of needing, let's say, 10 seats for a company, for example, now you only need 5 seats. So instead of the company having to pay for 10 subscriptions to Adobe, they only got to pay for 5. It's seat based currently. But if they only have 5 of those seats they're paying for, but then they add on the AI features, which is usage based, if it's able to have revenue still be higher than those original 10, then that's going to be a net tailwind, which would be good for the company. Then you have your middle case where it's neutral. So say it's that same scenario, 10 goes to 5 users only, but that AI credit basically keeps it a negligible change. So it basically doesn't change. The extra revenue they're getting from the AI basically brings them in line with the original 10. They're not really experiencing a lot of revenue growth, not a lot of loss. Now, the scenario that could be bad is if that seat dilution is either higher or they aren't able to upcharge as much for these AI credits. So let's say that 10, maybe they actually only need 3 instead of 5. And they're able to charge for AI credits, but they're not able to upcharge as much as originally expected. Maybe it's more commoditized now, for example. So now, with that seat dilution, they're not able to completely make up the loss from the seats with the AI revenue. In that case, revenue would actually start to downtrend, and we can see growth rates start to decelerate and potentially just start flattening out, which would be a very poor scenario. Now, having said that, the one thing that also does concern me on that is, like we're talking about with the 90% margins, I'm not sure they're going to be able to keep passing on the cost to the enterprises and the customers. Reason being, are they actually able to pass on the cost? Because in their products right now, they do have the actual like LLMs built in there, but obviously they got to pay for the use credits whenever people are generating, which they charge these AI credits so people can do it directly in their products. But one thing I'm thinking, are they going to be able to upcharge with that? Because if they're upcharging the credits and it's more expensive to do the generation on the LLM already based inside, let's say Premiere, and you're spending, let's say, X amount of credits with Adobe, let's just say like 10, something like that, and it ends up being, let's just say for simplicity's sake, you're spending $10 over here for this AI generation of this. Obviously, I'm throwing out fake numbers, but just for example, you're spending $10 within Adobe Premiere, and then you're able to go in and edit it. But if you were to take the same thing where, let's say, you use Nano Banana to generate that within Adobe, instead, you just go directly to Nano Banana, and maybe you are paying like $6. You generate it over there, and then you just export that, bring it into Adobe anyways. That could be a potential to where it's more commoditized and people don't necessarily use it within Adobe, or if they do use it in Adobe, because of that, Adobe's not able to upcharge on top of that. So they're basically just getting they're basically just charging what they're paying for the actual generative. And I'm sure they'll be able to upcharge a bit, but I'm not sure they're going to have extreme pricing power, which is something that kind of starts to concern me when I'm looking at this. Now, I just have a few of these slides pulled up that I pulled up from their presentation, We can see they have 13% year over year growth. Of course, there was an acquisition that took place, so some of this revenue growth was baking that in of about 500 million. And then we can also see over here that Acrobat and Express users, monthly active users, surpassed 850 million, growing 20% year over year, which I thought was a net good thing. And this is something they were talking about on the conference call, where they are starting to build more of a freemium model for a lot of their Adobe Express, especially to try and get people more into their ecosystem. So essentially, they're starting to let them use a lot of their features without even putting in any card information or signing up for an account, just to start attracting more users and try to kind of pull more of the new generation away from like Canva, for example, which is a very big player in the consumer staple. Now, Adobe does most of their revenue with enterprises, so it doesn't worry me too much, but I wish they did give us a split of how much of their revenue was generated from the consumer bases versus enterprises. But either way, I do believe the enterprise is much, much larger. And I do like that side more because enterprise revenue tends to be more sticky, as these big organizations are very slow moving. As someone who works in auditing, works with a lot of these big companies, they do not transition software very fast. Not a lot of them are so slow moving. It's so hard to transition from things. So that's going to help with the stickiness. But regardless, the other thing is this does kind of call into question with Adobe, how much of a moat do they really have? Do they even really have a moat? Because if you're having to give away your product for free, basically, and start easing the entrance into it, then your product must not be that desirable. So that's another thing that starts to worry me. Other things, so we can see their ARR growth is scheduled for 10.2%, which seems great and all, but when you're looking year on year from the past year, this is actually starting to decelerate, where it was closer to a 12.5%. So they're having still growth in ARR, but it's decelerating growth, which is also not that bullish. Of course, in the call, they have been talking about how this is due to that other strategy I just talked about, where it's going to start hitting ARR in favor of starting to growing the member base, which I see. But if they're not able to monetize that free base, then this is just going to be a net negative to the company. Additionally, on top of the CEO already leaving, which that originally didn't concern me too much, and it still doesn't really, because the guy's like 60 something years old, so I'm sure he wants to kind of step back and retire. He's been with Adobe for, I think I saw something like 40 something years. But now the CFO's leaving as well to go with, I'm trying to remember the name of the company. It was one of the chip manufacturers. Was it Marvell? I believe it might have been Marvell, but don't quote me on that. Either way, CFO is leaving as well, so interim CFO is taking over. That's originally with the CEO, it didn't concern me too much, and it still really doesn't right now, but stacking that on with the CFO, that's the two most important C-suite executives leaving the company, which isn't great, especially at a time where there's so much uncertainty with the future of the business. So that's a little bit concerning right there. Not the end of the world, but it's something that I personally don't like. Now, as we got to earlier, the stock price is very cheap right now. On pretty much any valuation basis you look at it, stock is very cheap. If we even come over here to some of the performance indicators, by all means, its metrics in the past have been looking pretty good. So if we're looking at their ARR, we can see still it's growing, which is very healthy. And if we go turn to the income statement, we can see consistent growth, which is what you'd want to see with the company. Again, the one thing that's concerning is, can they keep these margins up? And I kind of extracted their recent quarter earnings, and I graded them a C on their earnings for Q2 2026. Reason being right here is, personally, the one thing that I said was concerning me, which was margins, kind of looks like it might be playing out. For example, subscription revenue, we saw that grew 14% on the top line. However, the cost of subscription revenue is growing at a faster clip at 16%, which I don't like to see. Overall cost of revenue was still only up 12%, while revenue was 13%, so that's a good thing. But Could this get hit more over time and pressure more margins and pull down this gross profit margin from 92 to even maybe like an 87 or something? I'm not 100% sure. Additionally, we see the OPEX, the operating expenses, are up 17%, which I also don't like. Especially G&A was way out of control, up 45%. So with that, that's obviously going to hit your operating income. So while the top line was up 13%, operating income was only up 6%, which I personally don't like. And you can see net income was basically flat. Basically, the majority of your actual EPS growth that happened down here was just because of share buybacks. And that was pretty much 90% of the reason of this EPS expansion. Now, the one thing that is strong with those share buybacks is the company is in a great position to just retire some of those outstanding shares. If we go ahead and turn over here, which I believe it was, let's see, share, if I can go ahead. Okay, I'm not going to waste too much time finding that. But essentially, they just authorized another $25 billion to their share buyback. So in total, they have $27 billion that they can go ahead and spend on share buybacks, which the company right now is at a market cap of $77 billion. So buying back pretty much almost a third of the company, or that basically is a third of the company they could buy back at the current valuation, which when the valuation is already this cheap, I would expect the company to spend a lot of money on share buybacks, especially with the price of free cash flow of a 7.5. That could be great for shareholders. Now, real quick, I'm going to go ahead and turn to some of these analyst projections. Then I'm going to go through some of the insider transactions, and then we're going to go ahead and look at the DCF and go ahead and take a look at that, and then we'll turn over for some final thoughts so I don't make this video too long. So, first off, if we go ahead and turn over to analyst estimates, average price target of 326, which is 67% upside from here, a low price target of 222, about 13% upside from here. If we go ahead and look out into 2033, they're expecting a CAGR of about 7.8% of revenue growth. And for EPS growth, they're expecting about 12.1% of revenue growth, which could be undershooting it just because of the amount of share buybacks they can do. But I think that's fair, actually. 12%, yeah, I think that's fair, especially with the share buybacks. And then if the stock, they got to also factor in if the stock's starting to move by then obviously they're not going to be able to buy back as many shares. So I think that's fair, 12% CAGR out into 2033. Now, if we look at insider transactions, this is a one thing that also I don't like to see, because with the stock being so cheap, and obviously it's one thing for the company to spend the company's cash pile doing these huge share buybacks, but I like to see executives and some of the board members actually actively buying the stock, a lot of the insiders, because the only reason they're going to buy a stock is because they believe it goes up. And if they truly think Adobe is this undervalued and they don't have threat of disruption, and that's what they truly believe internally, they have the most insight on this. I'd expect them to be buying extremely heavy, especially at these valuations. But that's really not what you see. As you can see, it's just sells across the board at dirt cheap valuations. Like, look at this, 206, 32,000. That one's not too big, but 758,000 at 206. And of course, there's a lot of reasons to sell a stock, obviously, especially with these executives. They have a lot of stock just because of the amount of the amount of stock-based compensation Adobe does. Adobe does a lot of stock-based compensation. So a lot of it is just pulling out money for them to use. But even right here, like a block of sale for 3.2 million, 2.5, 12.5. That's a lot of shares to get rid of. And I get that he's getting a lot of shares, but if they truly think the stock is that undervalued, is this really the time for him to be selling, what's that, like $17 million, the CEO of the company, worth of stock? And you can kind of see, if you go into the ownership over here, it shows that net they are up on their shares. But again, that's just because the compensation they have is so high. So that one's a little tougher of a pill to swallow. But again, it's kind of hard to say, because maybe he just feels like he's too exposed to Adobe with how much they pay him in stock-based compensation for a lot of these executives. But still, if it would bring a lot of confidence if I saw some of the executives putting their money where their mouth is, you know? But finally, let's go ahead and turn to a DCF because I feel like this is what a lot of people want to see. And before I start on this DCF, because the numbers are going to look great, obviously, because, well, the valuation is so depressed. But something you got to remember to factor in with these DCFs is you can't just look at the calculations the computer is going to spit you out. Reason being is investing is kind of a mesh between those quantitative numbers and the qualitative factors of the business. And if you aren't meshing those two together, you're still going to get poor performance, even if you see a calculator that's saying, oh, you're going to get this CAGR if these expectations happen. You got to mix in both that story and the numbers. And it's very important to do, and something that newer investors need to keep in mind. Because if it truly was just as simple as buying really low PE stocks, very undervalued stocks, but not paying attention to the story, then we could just have computers running this. And you'd have just software and computers just running and beating the market consistently. Which, as we know, that doesn't exist. Or at least not to anybody's knowledge without someone like in the know that, who knows, maybe someone has some quantum computer or something doing this. But as of now, there's no publicly available trading bot type thing that can just consistently outperform the market. It takes that view of the story as well. So just keep that in mind and remember to factor in all those risk factors I talked about beforehand. So with this one, I'm going to go ahead and run with a slower free cash flow growth rate. I'm going to go ahead with a 7% free cash flow growth rate. Reason being, currently they're growing the revenue at about 10%. I'm going to say, okay, AI is going to be not a tailwind, not a headwind. It's just going to be neutral. And I'm going to say, in terms of actual revenue growth, but I'm going to say maybe they're not able to completely pass on the cost to the customer, so it's going to hit margin. So maybe they're not able to keep that free cash flow margin at a 40%. It's going to start to deteriorate. So I'm going to have the free cash flow growing slower than what revenue is expected to grow. And this is over a 5-year projection. Now, next one, I think 27 is way too high, especially growing at 7%. Currently, the valuation we saw on a price to free cash flow is it is around 8 right now. For conservatism, for this first one, I'm going to go ahead and run it at a 7, just because I don't want to factor in a lot of share price growth baked into that. So with a price to free cash flow of 7, keeping that discount rate at 10%, we see a fair value of 186, which is still below what it's at, and a CAGR of about 9%. Now, if we were to say, okay, 7's way too low, let's bump this up and say a price to free cash flow ratio of 10. You can see going up to a 10, that's going to dramatically increase your CAGR to about a 17%, fair value of about 266. And let's say this plus AI is more of a tailwind, not an extreme one, but more. So we'll say 9% free cash flow growth, still 10 price to free cash flow. You're getting close to a 20% CAGR. So as you can see, there are scenarios where this could play out, and I believe it could do fairly well, especially with the share buybacks. Like I said, they're able to buy about a third of the company. However, me personally, with my position, because I do have a position in it, right now I am just holding. Reason being, I need to see more proof in the numbers that AI is going to be a tailwind for them, or at least I need to see more proof that the bear case is not correct. I need to see a lot more evidence in the numbers that AI is not going to massively disrupt them and start having their revenue decelerate. Till I'm able to see something consistent and tangible in the numbers that's letting me know that revenue actually has a path to either stay at a constant growth rate or slightly start to tick up and accelerate consistently due to revenue, I'm not comfortable putting more money into this, even at these cheaper valuations. Additionally, I personally also just have other stocks that I am much more confident in that I'd like to still put in money. So this is going to pretty much stop the actual talk for Adobe, but just to pull up some of those other stocks that I'm still looking at. Again, This one is Zeta. I talk about it a lot, but the stock recently pulled down. So it had its little run up to about, very recently it ran up to 25. Then it crashed pretty much back down to the 19, which is fine with me. I'm still consistently picking this up. It's already a huge position in my portfolio, but this one I do have a lot of conviction in. They just grew their revenue 50%, 28% of that being organic. Great company. Love picking this one up. And then additionally, if you're thinking of more closer to the SaaS, I have been picking up CRM, but actually the one that I've been more bullish on, and originally I was doing a 1-to-1 buy ratio with this other stock, but I think I might start doing a 1-to-2, is ServiceNow. So I started doing more digging on this than when I initially did. And the more I looked into ServiceNow and Salesforce, both of these, the more I'm looking at it, and I think ServiceNow is a much stickier business model and is going to be much harder to disrupt, especially when I'm looking at it and I see how integrated they are with different companies, and just even my company does use them also. But then I had some stuff where I was kind of visualizing how much they're actually meshed in, and I feel like separating, like a big enterprise separating from ServiceNow would be so difficult, because they're essentially taking like the hundreds of different softwares used across different segments of the business of these large enterprises, and they consolidate it into ServiceNow and kind of makes everything speak to each other. And I just think the connectivity, it would be very hard to replace this. This isn't something that can be vibe coded easily into a replacement product. And I don't think any enterprise would actually do that. Additionally, like I said, I am an audit, and one of the things that's very important for a lot of these larger companies is having enough control over these different segments, because they need to, especially for these public companies. These SOC reports are very important, and it's very important to have adequate controls across the company, or else these public companies aren't able to file because their controls aren't going to pass, or it's going to be an extreme amount of testing that has to take place. So because of that, I'm actually more bullish on ServiceNow, which is another one I'm picking up in the SaaS space, and I rather allocate my money to this rather than Adobe, where Adobe I'm unsure, whereas the more I look into ServiceNow, the more I'm confident that this one is actually going to be a beneficiary of AI. Other one, not even a SaaS play. It's just a consumer play, but I still like Celsius at these prices. Again, if you haven't seen my actual DCF or my actual projections on Celsius, I can pull them up real quick. But as you can see on Celsius right now, at a price around the price it's at right now, I'm currently targeting around 20 to 30-ish range on the CAGR in my base case, and on a bullish case, I'm looking somewhere in the 40s or high 30s, low 40s for my CAGR. So those positions I'm really happy to build out, and SoFi also. SoFi, love at these prices, still picking up that. So again, make your own decisions on this. I'm personally going to go ahead and just continue watching quarter to quarter, see how things develop. I'm not in any rush to pick up more of the stock. I have other positions I need to build out. But let me know of your thoughts on Adobe. Do you think it's going to be a beneficiary? Do you think AI is going to completely take them out? What are your thoughts? Do you think maybe that AI is going to actually be a headwind, but you say, okay, the valuation is so cheap though that it still makes sense from an investment perspective? Because I could see that as well. Maybe like a cigar butt play that Warren Buffett used to do a lot back in the day. Are you seeing it as more of that type of play? But those are my thoughts on that. So I'm going to go ahead and end the video here, and I'll try to get this uploaded as quick as I can, get these thoughts out. Thanks for watching.